Have you ever wondered how banks decide whether to approve you for another property loan? If you are serious about growing a real estate portfolio, understanding how lenders assess your financial situation is crucial. In this video, I will break down exactly what banks look for when granting additional mortgages, from income and credit scores to debt-to-income ratios and cash flow. Plus, I will share insider tips on how experienced investors scale their property portfolios using smart financing strategies. If you want to build your real estate empire, stay tuned. This could be a game changer for you. So two things are really important when it comes to the assessment. First, they want to understand what is the difference between your assets and your liabilities. So that in the end. Second would be, how much is your monthly profit? I will explain it in a few seconds. Monthly profit means how much income do you have minus all your expenses, and how much is your monthly profit. Okay? Let's start with assets versus liabilities. Why is real estate such a great investment? And why is it pretty easy in Germany to scale a real estate portfolio? So first of all, let's assume you buy a property with a value of, let's say, 200,000 to get started easily. Maybe it's 300,000, 350, it depends on your budget, the location, and many other factors. So you buy a property for 200,000 euros. So you have assets of 200,000 euros. And you have a liability, if you do 100% financing, also of 200,000 euros. So now they typically want to see some equity, because if you're blank and there is no money anymore, then the ratio between assets and liabilities is not fine enough. What happens now in future? Well, your assets grow in value because of appreciation, and your mortgage becomes less because you repay the mortgage. What does that mean? Let's say after 4 years, the value grows to 220,000 euros. And the property, you have mortgage of, let's make it easy, 180,000 euros left. What does that mean now? We have 220 minus 180. So the result is you have 40,000 euros in book value, because you could sell the property for 220, you would give 180 back to the bank. So you have wealth created of 40,000 euros. Now what you could do, and this is now a really, really smart is the wrong word, or let's say experienced investors use that model. Now you can go to the bank and tell them, please give me 80% as a loan, which is a pretty cheap loan, and a significantly cheaper loan than a typical mortgage loan. Okay? So we have 80% of 40, so they give you 32,000 euros as mortgage for a really low interest rate. So what could you do now? You take 32,000 euros as equity capital and you buy another property. This is crazy. If with my properties, I'm always maxing out this, taking as much money as possible from the bank to buy as many properties as I can. This is exactly what experienced investors do, because now you can probably imagine that you're much faster in your wealth building, because you can save some equity yourself, you buy a property, then you take more money from the bank, even for the equity. You take 32 from the bank, give the bank 32 back, but then you buy another property, and this is your down payment for land transfer tax and notary fees. Okay? So now you could obviously do that with every property you own in future, which significantly accelerates your wealth building. So this is the first thing, assets versus liabilities. Real estate is great because your assets grow, your liabilities become less. So the ratio becomes better every year. So the bank is happy giving you further loans as long as you don't have any crazy personal loan liabilities and different car loans and 0% financing for many for furniture, kitchen, and so on. Okay? So now let's consider monthly profit. What happens now? Because many clients ask me, yeah, but if I buy a property with, let's say, €1,000 mortgage payment, then the bank won't give me another property for €1,000 mortgage payment, right? Well, actually, it's not right. Because let's say you have income of 5K net. Just as an example, we have expenses of €3,000 for living expenses, for rent, maybe for a mortgage, for home ownership. Oh, who knows? But let's say we have €5,000 income, €3,000 expenses. So you have a monthly profit of €2,000. So what happens now? You buy an apartment and you rent it out. So let's say you generate small apartment, you generate €800 rent, and you have €900 of costs, including mortgage, including maintenance, savings, including management of the property. So €900 for everything, including reserves and so on. So you have to invest €100 out of your own pocket. So what the bank does is they look at the €100 only. Can you afford another €100? If you can afford another €100 per month, they are happy to give you another loan if asset to liability ratio is fine, if the property itself is fine. But in general, the bank says, yeah, you can afford another €100. Why? Rental income is fully considered as income. So there is no difference between rental income or salary. It's the same for the bank. They don't care if you receive more rent or more income. It doesn't make a difference. So if you only have to invest €100 per month, and well, you can increase rents every 3 years by 15 to 20%. So after 3 years, you wouldn't pay anything anymore. So you could even buy one property every 3 years just with an investment of €100 per month. So it's really important to start as early as possible so the first property becomes cash flow positive after all the costs, so you can afford another apartment. But what can you do now? If you have the equity, you could buy maybe 6 months later another property where you have another time 800 minus 900, so 100 out of your own pocket, and then the bank just asks, can you afford another €100? And then if you can still afford it, they grant you another loan and another loan. The only thing which is important, and there should be a plan for, that you have 5.5 to 8.5% in equity capital, especially for maybe the first 1 to, maybe to be conservative, 3 apartments. After that, after 3 years, later stage, we always just do refinancing. If you say, well, let's go heavy on real estate and investments, then I would actually just continue saving that amount just to make sure that you're definitely in a position to buy further apartments. You save that money regularly. Let it be €20,000, depends on the property size. Then you know how much you can save on a monthly basis. Let's say you can save €500. And then we have €20,000 divided by 500. And then you know after month X, you can buy another apartment. Okay? Yeah, and this is really interesting. If you understand this, which is also quite special in Germany in comparison to other countries, then you know it's not that difficult to buy multiple apartments. It's just really important that you buy good properties with a good income to cost ratio. So it might be the case that some newly built apartments are not interesting because maybe the price is too high. It might be the case that some locations are not that interesting because the price to rent ratio is not good enough. This number is really important. You shouldn't have that many costs here. Obviously, to buy many apartments, if that's the plan. If you say, let's buy one property every 6 months, every 9 months, every 12 months, then it's really important to protect your cash flow. So it makes sense maybe to have a lower amortization rate, so principal rate. It makes sense that you maybe only have 1% repayment for the first years and not 2%, because then your cash flow is better. You can buy more apartments in the first place, and you can pay off the mortgages also later. This is not a problem. Typically, you plan first the real estate apartments, you first build your portfolio, and when you're done with building your portfolio, then you start paying off the properties faster. Yes, that's it. So now you know banks don't just look at your salary or savings when deciding on your next loan. They assess your overall financial profile, rental income, and existing debts to determine if you can handle more financing. By optimizing your debt to income ratio, using leverage wisely, and structuring your portfolio strategically, you can qualify for more loans and scale your real estate investments faster than you thought possible. If you found this video helpful, don't forget to like and subscribe for more insights on real estate investing and financing strategies, and let me know in the comments what's your biggest challenge when applying for additional property loans. Thanks for watching, and remember, the key to building wealth in real estate is knowing how to work with the banks, not against them. See you in the next video.